Hello, this is an example financial forecast for some clients looking at their inheritance tax liability under the rules post the 2004 budget. The case study in question has been taken from some clients of ours and annotated and slightly adjusted. But here we have the family, Mr. and Mrs., with their adult children and now two grandchildren. They have a general spending need of around £8,000 per month, and they have a holiday spending need of around £2,000 per month. And they want to be sure that at the point, or if they were to get to the point of needing care, they could afford that. And the combined cost of that would be the safety net and the general spending need when you add those two together. And you can see this within the financial cash flow where their total spend, the 96 plus their holidays, increases. Then when they hit 90, they assume that they're going to holiday less, and so those holidays fall off until they reach a theoretical care need position where those costs jump up again, and all of that is increased in line with inflation. What we then look to do is build out all of the different assets that they have. So in this instance, this family built wealth up within a business that they ran together. It allowed them to create a solid amount of cash and cash equivalent savings, some really good ISA savings that they've been saving through for their lives, a significant offshore bond that they held assets in, a really lovely main residence, and it's a property they want to stay in for the rest of their life. They have a Spanish holiday home, and then they had the company SAS with assets in as well, alongside their state pensions. So when we looked at this overall scenario, it was clear that their objectives could be met, and we look at their overall asset position over time, where we have their pensions, their savings and investments here, and their property. Ultimately, their liquid assets generate enough return to be able to afford the lifestyle that they want, and so therefore their assets grow over time, over the whole period. So a very clear financial plan, a very comfortable financial position, and something that they probably already knew. However, the question now was, what about inheritance tax, and how much might our inheritance tax liability be, and what could we potentially give away? A very common question we get with a lot of our clients is, how much can I afford to give away? And so in this instance, we can see what their estimated IHT liability is. So right now, it's just under £2 million. As their estate grows, that increases. We have a jump here because this is where pensions then become IHT liable, and that increases over time over here. So you've got that ever increasing inheritance tax liability with an ever increasing estate value, pretty much what we would expect. So the other question is, well, how much could you give away? A really quick way of looking at that would be to say, well, how much could your investments fall by today, and you still afford that lifestyle that you want? And you can see in this analysis that ultimately the assets could fall by about 60%, amounting to 2.65 million of liquid asset reduction. And if that was the case, the plan all stays blue. They can afford the lifestyle that they want, but their liquid assets reduce over time, and they're left with just their physical assets, their properties. Now, this doesn't completely remove an inheritance tax liability, but it would reduce the liability. Now, the clients weren't immediately comfortable on giving such large sums away, so they wanted to look at the different ways in which they could look to save some inheritance tax. And so we started with the position, let's focus on ensuring they can afford the lifestyle that they want, but then let's see what we can do in terms of structuring different IHT efficient vehicles. So one of the things we did was move relatively small amounts into business property relief investments. So where business property relief has been reduced over in the recent budget, but it's not been completely removed. And so you do have an allowance of up to £1 million. Now, with the client's liquid assets, this felt like a comfortable starting position. And so in 2 years' time, these assets could be removed from the overall estate value for inheritance tax. And then we've also created a trust, and you can see the figure here is 400,000. The reason being is that we've crystallised the tax-free cash element of their pensions, and we've used that to gift that into a family trust here. Alongside that, we've also taken out a whole of life insurance contract, and so that will pay out a lump sum of £1.5 million on the last of the family's deaths, and there is a monthly cost to that, which they are comfortable and happy enough to pay. And then we have these regular gifts that they weren't previously making of £3,000 each. We have a future gift, this big, large gift here, and what this indicates is this spike in the plan. And really, when the clients reach around age 80, they feel today like they will be comfortable gifting a large sum away. And a great asset to do that would be an offshore bond, because it ultimately is portable. It can move without creating a tax liability from individuals into trust. And so this is what we've suggested in that instance, only when those clients are comfortable that they know they've got enough money and wealth outside of these assets. And then finally, to actually generate the income that they need, we've turned on some of the income from the pensions. Now, the income that we've started from these withdrawals, we haven't started until here when the pension legislation change occurs. So from there on in, we're starting to draw down from pensions, reducing those assets. And so you can see we have a fully blue plan still. Ultimately, assets still increase over time. But whereas we used to have lots of pensions assets, we've now got a significant amount of investment assets. And those invested assets include the family trust. So moving forward, if we're now looking at comparing where they were at the beginning to where they are now, we can review this on a like-for-like basis. So at the top, we have the estate planning in force. I'm going to remove the total wealth. And on the bottom, we have their original starting position. So we ran through this previously, 1 million increasing to 2 and increasing to 5. Whereas over here, we can still see that jump where pensions come into the estate, but we can see the first fall off 7 years after that original gift of the tax-free cash from the pensions, and then another significant fall off which comes from the secondary gift of the offshore bond. Now this does level out over this time period because we're now spending down from pensions. We are also gifting away the 3,000s. And the reality is that there are future gifts that could be made during that period. But what we also did was we took out that life assurance policy to ensure that actually 1.5 of this 2.3 million liability would be covered by the insurance policy. And so from their liquid assets, their liquid estate in this financial plan, there is probably around about £800,000 of liability that needs to be found. And we know from looking at the liquid assets, there's a significant amount of liquid assets there available to pay for that liability. It's often the case that people think a full IHT free position will be secured, but that's very unlikely. And actually, when you look at the detailed legacy of the planning, there's usually some tax to pay. However, there's different ways that we can go about funding that tax. And when you do some of these calculations, you can start to bring in where the assets are going to be paid for, where they're going to come from, the fact that the life insurance here is at 1.5 million, but 0 of that is taxable. If we look at the savings and investments, we've got 8.117, but actually 6 million of that now sits outside of the estate and because it's in trust, and so therefore has 0 tax liability. There is a lot of different things you can do with inheritance tax planning, a lot of different options that are available Each comes with positives and negatives, but ideally what we want to be able to show is that clients can live the life that they want to live and afford to give, and make sure that those two things are in balance, and make sure that when our clients are gifting, they're doing so with total confidence and clarity about their future. Thank you, and if you want to talk through any inheritance tax strategies, please feel free to reach out to Beckett's.